Welcome back, traders. In today's episode, we're diving into a highly effective 1-minute order block trading strategy designed to capitalize on institutional liquidity during the New York Stock Exchange opening hours. Without further ado, let's get into the video. To begin, we start with the 15-minute time frame to determine the overall market structure, ensuring we trade in the direction of the dominant trend. If the market is in an uptrend, we look for a series of higher highs and higher lows, indicating sustained buying pressure and potential buy setups. Conversely, if the market is in a downtrend, we identify lower highs and lower lows, signaling increasing selling pressure and ideal conditions for sell setups. However, if price is moving sideways without establishing a clear trend, we wait for a breakout before making any trade decisions. Next, at 9:30 a.m. Eastern Time, when the New York Stock Exchange opens, we mark the high and low of the first 5-minute candle. This key liquidity zone serves as an institutional reference point where large orders are placed, often triggering strong breakouts. If price breaks above the high, we focus on buy setups, and if it breaks below the low, we prepare for sell setups. Once a breakout occurs, we refine our trade execution on the 1-minute time frame using one of two entry models. Entry Model 1 involves placing a limit order at the 1-minute order block, ensuring an optimal entry at a key price zone. A stop loss is placed below the order block for buys and above it for sells, with a target set for a 1-to-2 risk-reward ratio. Entry Model 2 is a confirmation-based entry where we wait for a clear shift in market structure, confirming price rejection at a significant level. Once this shift is validated, we place a limit order at the newly formed order block, with a tight stop loss below the block for buys and above it for sells. Also, the profit is set at 1-to-2 risk-reward ratio. This method provides additional confirmation, reducing the chances of premature stop-outs. If price continues with strong momentum after our initial trade, we can consider a re-entry trade, but only if a new order block forms in the same direction. Then, we place a limit order at the new order block, with a tight stop-loss below the block for buys and above it for sells. Also, the profit is set at 1-to-2 risk-reward ratio. However, to manage risk effectively, we reduce risk by half on the re-entry trade to protect profits while still capturing extended market moves. Effective risk management is crucial to long-term success. You should risk only 1-to 2% of your capital per trade, ensuring that no single trade significantly impacts your account. Make sure to reduce risk by half for re-entry trades to protect profits while still capitalizing on strong momentum. For example, if you risk 1% on your initial trade, your re-entry trade should risk only 0.5%. If you risk 2% per trade, your re-entry trade should be reduced to 1%. This ensures that you maintain controlled exposure while maximizing opportunities in trending markets. Also, since the most high probability setups occur within the first 2 hours of the New York Stock Exchange open, you only need to trade from 9:30 a.m. Eastern Time. Additionally, marking key levels on the 15-minute time frame, such as order blocks, support, and resistance levels, will provide added confluence for trade decisions and increase accuracy. The best instruments to trade using this strategy are NASDAQ and S&P 500, as they provide high liquidity, strong momentum, and clear institutional price action during the New York Stock Exchange open. Enough of boring theory, let's do some chart analysis. The market structure of the NASDAQ on 15-minute chart has been predominantly bullish, with a clear uptrend characterized by a series of higher highs and higher lows. The price initially moved upwards with strong momentum, breaking through multiple resistance levels and establishing new highs. Throughout this phase, each pullback remained higher than the previous one, reinforcing the bullish trend. As the trend progressed, the price eventually formed a double top, indicating a temporary pause in bullish momentum. Despite this formation, the market did not break the previous strong low, suggesting that buyers are still maintaining control, preventing a deeper pullback. Instead of continuing the strong uptrend, the market has recently entered a sideways movement, fluctuating within a defined range without making new highs or significant breakdowns. Also, it's important to mark the previous bearish order block, as this zone can serve as a profit target level. Next, at 9:30 a.m. Eastern Time, we mark the high and low of the first 5-minute candle. Now, we switch to the 1-minute time frame to refine our entry. The focus is on identifying a bullish order block, which is typically the last bearish candle before a breakout. This level serves as a high probability support zone where price is likely to react before continuing its upward movement. For entry model 1, we place a limit order at the bullish order block, allowing price to retrace before executing our trade. The stop loss is positioned just below the order block to protect against invalidation, while our target is set at a 1 to 2 risk-reward ratio. As price retraces back to the order block, it finds support and begins to move higher, successfully triggering our buy trade. Price continues upward and eventually hits our take profit, securing a solid 2% gain. Shortly after, price suddenly pulls back sharply before continuing its upward trend, leaving behind a rejection block, a sign of indecision and potential support. For a re-entry trade, we place a buy limit order at this indecision candle or newly formed bullish order block. The stop loss is set just below the block, and the target is again a 1 to 2 risk-reward ratio. However, to manage risk effectively, we reduce our position size by half. In this case, the trade carries only 0.5% risk of the account. Unfortunately, price briefly sweeps our stop loss before continuing upward, invalidating the second trade. Despite this small loss, we still walk away with a net gain of 1.5% on the day, thanks to the first successful setup and proper risk management. Let's take a look on another example. The market structure on the S&P 500 15-minute chart initially shows a strong uptrend, with price forming a clear sequence of higher highs and higher lows, indicating bullish strength. This upward momentum continues until the market reaches a peak, after which a significant structural shift occurs. Following the high, the price breaks below a previous strong low, signaling a change of character. This is the first sign that the bullish trend may be losing steam and that a potential reversal could be in play. Right after this structural break, we observe the formation of a head and shoulders pattern, a classic bearish reversal signal. The left shoulder forms during the uptrend, the head extends to a new high, and the right shoulder fails to break that high, confirming waning bullish pressure. Following this, the market enters a sideways phase, consolidating in a tight range without clear trend direction. This phase represents indecision, as both buyers and sellers appear to be waiting for more confirmation before taking control. During this consolidation, it's important to mark key order blocks, especially indecisive candles or small-bodied candles with wicks on both sides. These areas, such as the two indecisive candles near the end of the range, can act as potential reversal zones or take profit levels for long positions. If price returns to these levels, they could either serve as a bounce point for continuation trades or a target for partial or full profit booking, depending on the broader directional bias. Next, at 9:30 a.m. Eastern Time, we mark the high and low of the first 5-minute candle. We zoomed into the 1-minute time frame to look for a refined entry after marking the NYSE open 5-minute high and low. As price consolidated within this zone, it showed indecision, presenting potential for both buy and sell opportunities. Initially, price displayed bearish momentum with a strong shift in structure to the downside. Using entry model 1, we placed a sell limit order at the bearish order block with a stop loss above the zone and a 1 to 2 risk-reward target. For entry model 2, we waited for a confirmed structure shift, then placed a limit sell at the newly formed bearish order block with a stop loss just above it and same risk-reward ratio as entry model 1. However, shortly after, the market reversed sharply to the upside, breaking above the 5-minute high and sweeping our short position stop loss, resulting in a 1% loss. With this bullish breakout, we immediately switched our bias from short to long, recognizing the strong momentum now favoring buyers. As price retraced after the breakout, we looked for a bullish entry model 1 setup, placing a buy limit order at the bullish order block formed just before the breakout, with a stop loss below the order block and a 1 to 2 risk-reward target. For entry model 2, we waited for a clear shift in structure to the upside, confirming that buyers had taken control. Once this shift occurred, we identified a newly formed bullish order block and placed a limit buy order at that level. A stop loss was set just below the order block, and the target remained a 1 to 2 risk-reward. In this case, entry model 1 was triggered, and price followed through strongly, hitting take profit and recovering our earlier loss. If you were looking to enter using entry model 2, you would place a buy limit order at the fresh bullish order block formed after a clear change of character. That trade also reached its take profit. resulting in a 2% profit for the trade. For the re-entry, you can use entry model 2 if model 1 was your initial trade. In that case, both trades would have reached their targets, allowing you to close the day with a 2% profit. However, if you use model 2 as your initial entry, a re-entry opportunity did appear shortly after hitting take profit. Since it was already past 11:30 a.m. Eastern Time, we followed our trading rules, canceled all pending orders, and closed the day with a solid 1% net gain, demonstrating discipline and consistency in execution. That wraps up today's video about this 1-minute scalping strategy. Be sure to check out other videos in our Smart Money Scalping series. If you found this video helpful, make sure to like, subscribe, and turn on notifications so you never miss out on our latest trading strategies and insights. Thanks for watching, and I'll see you in the next episode.